First to the market reaction, Subadra. Appropriate reaction right now from the market based on the numbers?
Absolutely. The curve is bull steepening, which is kind of what you would expect if the market is trying to communicate its expectations for a Fed rate cut sooner rather than later. I mean, we've done an analysis on Fed going back in time, and any time the first Fed funds futures contract versus the fourth Fed funds futures contract inverts, typically around, say, negative 25 basis points or flatter, you tend to see that the Fed comes in a month and a half afterwards and cut rates. So this, to me, is again another data point that the Fed has to look at when it's looking at monetary policy.
Constance, we talked earlier about to what extent the trade conflicts may be leading to this. I think people will want to jump to that conclusion. Is it too early to jump to that conclusion?
Yes and no. We saw a pullback in investment in the first quarter. And that, to me, it speaks to uncertainty around what's going on with trade. But I want to add that, let's say the Fed cuts rates in June or July. Is that enough? If we get increased tariffs, is that enough to save the economy? I think there's a big question mark around that, and I think there's a strong possibility it's not enough. And I think that is what is really freaking out the bond market.
Now, one of the things we saw in ADP was that it was manufacturing, it was producing things rather than services. Services actually did much, much better. Is that reflected in these? Oh, Mike McKee.
Well, I mean, we don't have the full report.
Let me go to Mike. It's hard to see Mike because Mike is in Washington. It's a long way. My eyes are not that good. But Mike, you wanted to add something.
Well, I just want to note that we have to be careful because this is 1 month, and we have seen this before. We saw weak hiring in February, and then it rebounded. There are seasonal adjustment problems when you start to come into the summer. So the Fed is going to look past this and say, we want more data. Obviously, it tells a story of a weakening economy if it continues, but we don't know that it necessarily is going to. Maybe we're at a point now where we're going to see hiring dialed back. You look at construction, this is a prime construction period, only 4,000 jobs. Maybe they just can't find the workers, and that would be a different calculation for the Fed.
So I think we need to look at the 3-month and 6-month averages, right? So historically, now we're at 151,000 for 3 months, 175,000 for 6 months. That is a really important fact, that this is starting to drift down. Our forecast is that we're going to go down to 100,000 jobs per month on average by the end of the year. That may turn out to be optimistic.